Hey everybody, this is the guided assignment for chapter 20, where we're going to look at contribution margin and break-even sales and lots of other good stuff. In essence, what they're going to do is have us create an income statement from all of this information up here. And you can see it's broken into production costs, selling expenses, and administrative expenses. And then the costs are given to us in an estimated cost per unit sold on a variable cost, and then an estimated fixed cost for some of the things as well. So to start our income statement, we're going to have our sales revenue, or just sales, and we're going to calculate that because it tells us right here that we're expected to sell 21,875 units at a price, whoops, not plus, times a price $160 per unit. So we're going to expect sales of 3,500,000. And we're going to use the word expected throughout this because this is just an estimate, what we think we're going to sell. So then our cost of goods sold is going to be broken down into these three categories: direct materials, direct labor, and factory overhead. And again, we're given a variable cost per unit sold. So we know, again, the estimate is 21,875 units. We're going to multiply that by the direct materials cost of $46 per unit. So we think our direct materials will cost $1,006,250. Our direct labor is estimated at $40 per unit. So again, we'll take the 21,875 units times $40 per unit, gives us 875,000. Then our factory overhead is a fixed cost of 200,000 plus $20 per unit sold. So I'm going to take 21,875 units times $20. That gives us the variable component of our factory overhead plus the 200,000 in fixed costs on the factory overhead. That gives me a total of 637,500. So our total cost of goods sold will just be the sum of our direct materials, direct labor, and factory overhead. Comes out to 2,518,750. And then our gross profit will be our sales minus our cost of goods sold. Minus 2,518,750. So a gross profit of $981,250. All right, now we're going to do our expenses. We'll start with our selling expenses, which will be given to us right here. We have sales, salaries, and commission, advertising, travel, and miscellaneous selling expenses. And then again, we're going to look at each one of these. So we see sales, salaries, and commissions has a variable component of $8 per unit sold plus $110,000 fixed. So I'll take 21,875 units times $8 plus 110,000. Gives us 285,000. Advertising is purely a fixed cost. So a $40,000 fixed cost. So no variable component there. Travel, $12,000 in fixed costs. And then our miscellaneous selling expense has 13,400 in fixed costs plus $1 a variable per unit sold. I'll take 21,875 units sold. If I want to, I can say times $1, which is going to be 21,875. plus the fixed cost of 13,400 gives us a total miscellaneous selling expense of 35,275. All right, so we'll add all these up to get our total selling expense. We get 372,275. Our administrative expenses, we have office and officer salaries, supplies, and the miscellaneous administrative expenses. We can see our office and officer salaries is a fixed amount, 132,000. Our supplies was a fixed amount of 10,000 plus $4 per unit sold. So I'll take 21,875 units sold times $4 per unit plus the fixed amount of 10,000. 97,500. Finally, our miscellaneous expense looks like a fixed cost of 13,400 plus $1 per unit sold. So 21,875 times 1 plus 13,400 in fixed costs, total of 35,275. We'll add those up to get our total administrative expenses. It's 264,775. Then we'll add the administrative expense total to the total selling expenses, and that'll give us total expenses. And then we'll subtract the gross profit from the total expenses, and that'll give us operating income. And then at that point, we'll use one of our checks to make sure I didn't make an arithmetic error, because it's very possible with all the math I just did there that I made an error. Check it. Oh, look at that. So I do have some errors. And it looks like it starts with my miscellaneous selling expense. I'll go back up to that and I'll say, okay, it's 7,600 plus $1 per unit sold. So I'll do 21,875 plus 7,600 gives me 29,475. And as we're all aware in accounting, we make one error and it all carries through, right? So now I'll recalculate my total selling expense by, whoops, that wasn't a good start, was it? 285. Looks like it is, something's not right there. Let's do that again. $366,475. Now we'll add 366,475 plus 264,775. We get 631,250. And then we'll subtract that from our gross profit. And I get 350,000. And that, my friends, is what checks are for, right? Because even someone who's done this lots of times, like I have, can make a mistake. Okay, so now we're going to ask, what's our expected contribution margin ratio? There's a couple ways to do this. We can either take our total contribution margin and divide that by our total sales, or we can take our contribution margin per unit and divide that by our sales per unit. So we can do that either way. So to figure out our contribution margin, we're going to have to take, remember, contribution margin is our sales minus our variable costs. So if we look at this table right here, we have our variable costs per unit sold. So if we wanted to find our total variable costs, we could just multiply that times 21,875. That's going to be our total variable costs. Now, if we subtract that from the sales, that's going to give us our contribution margin, 875,000. The fact that this matches our direct labor here is just a coincidence. Don't get any ideas that that would be like always the case. Okay, just it's coincidental. So to find our contribution margin ratio, then we take our contribution margin and we divide that by our sales. And I get 25%. Another way we could have done that, just to show you, is we could have just taken our contribution margin per unit. So we know if we sell a unit for $160 and our variable cost per unit is $120, that gives us a $40 contribution margin per unit. Then we just divide that by the sales price per unit, and we get the same 25%. So there's our expected contribution margin. So next it wants us to calculate our break-even sales in units and in dollars. So to figure out how many units we would have to sell to break even, all we're going to do is take our total fixed cost, which is given to us right here. And we're going to divide that by our contribution margin per unit. And so remember I said our contribution margin per unit is our sales price per unit, 160, minus our variable cost per unit of 120. So our contribution margin per unit is $40. So if I take 525,000 and I divide that by 40, I come up with 13,125. So I'm going to have to sell 13,125 units in order to break even. Think about what we're doing there is we're taking that total fixed expense or fixed cost. We know that each unit we sell is going to contribute or give us a contribution margin of $40 per unit. And so if we just take the total fixed costs we have to cover, divide it by that contribution margin we make for each unit, tells us how many units we're going to have to sell. There it is, 13,125. And then we have to find our break even in dollars. There's a couple ways of doing this. One is we know we have to sell this many units to break even, and we know we're going to sell the units for $160 a piece. So if we just take our break even units, multiply that by the sales price, we get our how much we're going to have to sell, which is 2,100,000. Another way of doing it is to take our fixed cost, 525,000, and divide that by our contribution margin ratio, which, if you remember, we just calculated down here was 25%. And give us the same answer, $2,100,000. So in order for us to break even, we're going to have to sell 13,125 units, or we're going to have to sell $2,100,000 worth of units. That's going to be our break even. At this stage, I'm going to go ahead and check my work just to make sure I haven't made an error, and I didn't this time. So the next thing it wants to do is have us construct a cost, volume, profit chart on our own paper, and then to use that to figure out the break-even sales. There's no easy way for me to do this on a computer, but if you remember, in fact, I'm going to do is pause this and I'll pull up a CVP chart so you can see it, and maybe make your own just for the practice of it. All right, up on the screen I have just from the textbook a cost, volume, profit chart. Not sure if that will help us see it better or worse. It doesn't seem that much better. It doesn't seem that enlarged, does it? Anyway, so for our problem, so remember this line here, the bottom line that starts at 0 and goes up, that line is our total sales. So for our problem, we know that we're selling units at $160 a unit. So at 0 sales, we would have 0 units sold, we would have $0 in sales. At 1 unit sold, we'd have 160. At 1,000, we'd have 16,000 units sold or in sales. And so ours would go up at that slope, which is $160 per unit. There's our total sales. This line is our total costs. So it would start at our fixed costs, which in our problem are 525,000, and then increase. So we'd start at 525,000 and then increase at a rate of $120 per unit. And so then our total sales and total costs would cross at some point, and that would be our break-even point. And the point at which they would cross would be, we just figure out here, would be 13,125 units or $2,100,000 in sales. So I didn't exactly graph it out for you, but I hope that helps you to go through the process because it could be a valuable thing to do. Then it asks you, what's the break-even sales? Well, it's the same as it is when we calculate it. So it's still $2,100,000. So next they want our margin of safety in dollars. And so the margin of safety is just the amount that we're selling over and above our break-even point. So we can even see it right here. It tells us sales minus sales at break-even point divided by sales equals the margin of safety. Okay, so we know our sales is 3,500,000. We know that our sales at break-even point is 2,100,000. So 3,500,000 minus 2,100,000. That is our sales above the break-even point. And then we're going to divide that by sales. Oh, wait, so it's going to want it in dollars. That's the answer, $1,400,000. That's our margin of safety. So we need 2,100,000 to break even. We're selling 1,400,000 above that. And then as a percentage of sales, we just take that amount and divide that by sales, 3,500,000 or 40%. So we would say we have a 40% margin of safety that is $1,400,000. The last one it wants us to calculate is the operating leverage. So the operating leverage is just our contribution margin divided by the income from operations. So I'll show you again how to calculate the contribution margin. Contribution margin is just sales minus variable costs. So we know our sales were 3,500,000 and our variable costs were $120 per unit times 21,875 units. So let's do. So there's a total variable costs. We'll subtract that from, ooh, something was weird there. Let's try that again. So 120 times 21,875. There's our total variable costs. Subtract that from 3,500,000. Should give us, what in the world? Sorry, that's doing something weird to me. I'm probably typing in something weird. 21,875 times 120. There it is, $875,000. That is our contribution margin. Again, I could have done that also by taking the contribution margin per unit, which is 160 minus 120, which is 40, and then multiplying that by 21,875. Anyway, we're still down here trying to figure out our operating leverage, which is our contribution margin right there, divided by the income from operations, which is also called operating income. So we get 2.5 for our operating leverage, and that should be it. Let's double check. Looks like we got it all right. So hopefully that helps you work through the guided problem.